There is a single rule buried in the paperwork of almost every joint bank account in America, and most people who signed it have no idea what it actually means. That rule determines whether your money goes where you think it does when you die, or disappears into a legal process that can take months, cost thousands, and override everything your will says. And right now, millions of seniors are sitting on joint accounts where that rule is working against them. If you share a bank account with a spouse, an adult child, or anyone else, you need to understand exactly what that rule says, what it does to your money, and what 3 things you can do right now to make sure your account is set up the way you actually intend. Stay until the end. The last one is the one most people never think about, and it is the one that can quietly cut the wrong person out of everything. These rules are the kind of thing that only becomes visible when it is too late to fix. That is what this channel covers, what the fine print actually says, what it means for your money, and what to do before it becomes someone else's problem. Subscribe now and turn on the bell. It is free, it is plain English, and there is nothing to sell. Here is what makes this so dangerous for anyone over 60 specifically. Joint accounts are one of the most common financial tools in America. Couples use them for daily expenses. Parents add adult children so someone can help manage bills or step in during an emergency. And for decades, the general assumption has been simple. If your name is on the account, you have access to it. And when you die, your share goes to your estate. That assumption is almost certainly wrong, and no letter is coming to tell you this is happening to you. The mechanism is called the right of survivorship, and understanding it will make you angry in a useful way. The kind that makes you call your bank this week. Here's what it actually means. A joint bank account with right of survivorship passes automatically to the surviving owner when one owner dies, skipping probate entirely. The legal name for this arrangement is joint tenancy with right of survivorship, often abbreviated JTWROS. Because the transfer happens by operation of law, the account balance is not controlled by the deceased owner's will and does not go through court proceedings. Read that again slowly. Not controlled by your will. The moment you die, every dollar in that joint account belongs entirely to the other person on the account, automatically, immediately, and permanently, regardless of what your will says, regardless of what you intended, and regardless of whether that person was supposed to share it with anyone else. The system built this way not to protect you, but because it is efficient. Banks do not have to wait for courts. Money moves fast. But the person it moves to may not be who you thought it was, and by the time anyone realizes the mistake, the account has already transferred and the money is gone. Now here is the objection I know some of you are thinking right now. My account looks fine. I set it up years ago with my spouse and everything is working normally. Nothing has changed. That is exactly the problem. The right of survivorship is invisible while both of you are alive. You both have full access, transactions process normally, direct deposits land without issue. The rule only activates at the moment of death, and by then, you are not in a position to correct it. The viewer who thinks this does not apply to them is usually the one it affects most, because they are the one who never checked. And here is the second objection. You might be thinking, I am not the one who is going to die first, and we have already agreed on how things will be divided. That agreement means nothing legally if it was never put in writing in the right way. A right of survivorship in a joint account is no longer absolute. Whether a joint account has an enforceable right of survivorship will turn to evidence of the initial account holder's intent, which, in the case of a decedent, can include statements made in a will. But here is the catch. Even if your will says one thing, the account's survivorship designation can override it. A verbal agreement between you and your co-owner means nothing to the bank. The first thing you need to understand is what your current account actually says, and most people genuinely do not know. The most important factor in determining whether a joint account has rights of survivorship is whether the bank signature card establishing the account identifies the interests of the parties as being with rights of survivorship. Obtaining a physical copy of the signature card from a bank can be difficult due to numerous bank mergers and the passage of time from when the account was created. That last sentence is critical. If your account is more than a few years old, or if your bank has been acquired or merged since you opened it, the paperwork establishing the survivorship designation may be buried, incomplete, or unclear. You cannot assume the account is set up correctly just because it has been operating normally. The survivorship rule is silent until death activates it. Call your bank this week and ask them directly, is this account designated as joint tenancy with right of survivorship, or is it tenants in common? Ask them to send you written confirmation of the designation. If they cannot tell you clearly, that is itself a problem that needs to be fixed. The second thing you need to understand is the Medicaid trap, and this one specifically targets seniors who may need long-term care in the coming years. Joint accounts create a particular trap for anyone who might need Medicaid to cover long-term care. Federal law imposes a 60-month look-back period for asset transfers before a Medicaid application. If an applicant transferred assets for less than fair market value during that window, Medicaid will deny coverage for a penalty period calculated by dividing the transferred amount by the average monthly cost of nursing home care in the state. Here's what that means in plain language. If you added your adult child to your bank account in the last 5 years, even for completely innocent reasons like helping you pay bills, Medicaid can treat the money in that account as a transfer of assets and deny your coverage for nursing home care until a penalty period expires. The penalty period is calculated based on your state's average nursing home cost, which in many states exceeds $9,000 per month. A joint account with $50,000 in it, added 3 years ago, could generate a 5-month penalty period during which Medicaid pays nothing. That is $45,000 in nursing home costs you would need to cover yourself because of an account you set up to make things easier. Swift probate. The action here is specific. If you have added anyone to your bank account in the last 5 years and you may need Medicaid-covered nursing home care in the future, do not wait. Call your state's Medicaid office or a licensed elder law attorney and ask for a review of how your joint accounts are classified for the look-back period. Do not assume it will sort itself out. It will not. The third thing you need to understand is the gift tax issue. And this one surprises almost everyone who has a joint account with an adult child. Simply adding someone's name to your bank account does not trigger a gift tax obligation. Under federal regulations, a completed gift does not occur until the non-contributing owner actually withdraws funds for their own use. If you deposit $50,000 into a joint account and the other owner takes out $20,000 for themselves, you have made a $20,000 gift. If that exceeds the annual gift tax exclusion, ISPA, which is $19,000 for 2026, you would need to file a gift tax return. Most people never realize that withdrawals made by their adult child from a joint account are legally treated as taxable gifts from the parent. Every time your son or daughter takes money out of that account for their own use, you may have a gift tax filing obligation. Filing does not mean owing. The lifetime estate and gift tax exemption for 2026 is $15 million. So most people will simply reduce their remaining exemption rather than write a check to the IRS. But the failure to file IRS Form 709 when required is a real penalty exposure that most families with joint accounts never even think about. Swift probate. Swift probate. The exact action here, if your adult child has been making regular withdrawals from a joint account you fund, and those withdrawals exceed $19,000 in any calendar year, you need to file Form 709 with your federal tax return. Download it directly from irs.gov and consult a tax preparer if the filing is unfamiliar. The form itself does not create a tax bill in most cases, but failing to file when required can. Before this week is over, do these 3 things. First, call your bank, use the number on the back of your debit card, and ask them to confirm in writing whether your joint account is designated JTWROS or tenants in common, and whether the designation matches what you actually want. Second, if you have added anyone to your account in the last 5 years and you may need Medicaid in the future, contact a licensed elder law attorney or your state Medicaid office to review whether those accounts create a look-back problem. Third, pull your last 3 years of tax returns and confirm that any large withdrawals made by a joint account co-owner were either below the annual gift tax exclusion or properly reported on Form 709. 3 steps, 2 phone calls, 1 document review, and potentially the difference between your money going where you intended and disappearing into a legal process no one can stop once it starts. The cut happens on its own. The account transfers at the moment of death, automatically, without review, without warning, without regard for what your will says or what you meant to happen. Stopping it is entirely on you. That is not fear-mongering. That is how the system is built. If you know someone over 60 who has a joint account with a spouse or adult child, and that is almost everyone you know, send them this video. Not because something has gone wrong yet, because 5 minutes of awareness right now is worth far more than months of legal untangling later. That is what this channel is here to do.